Okay, I have 6 o'clock, so we're going to get this thing started. Good evening and welcome. On behalf of the City of Auburn, we appreciate you joining us for this virtual town hall meeting. My name is Liz Allen. I'm the Director of Communications of Community Engagement for the City of Auburn. I'm joined this evening by Kelsey Earle, Auburn's Deputy Director of Finance. This evening is being recorded, and it will be available on the city's YouTube channel soon after the conclusion of the meeting. To find it, just visit youtube.com and search City of Auburn, Maine. As you know, Auburn's assessing department has recently made some valuation adjustments that may affect your property's value. The difficult decision to increase values is based on several years of high sale prices and the city's efforts to remain in compliance with state assessing standards and best practices. These changes are in effect for the 2022 tax year. We're here this evening to help explain these changes and to answer any questions you might have. If you're joining us via Zoom and wish to submit a question, please click on the Q&A button and type your question there. We encourage you to share your first name, but it's certainly not required. We ask that you please do not ask questions that are specific to your property. We will not be answering those this evening. If you do have a property-specific question, we encourage you to make an appointment or stop in to visit us here at Auburn Hall, or give us a call at 333-6601. If you do call and leave a message, we ask that you're patient if we don't reply right away. We're fielding lots of calls right now, and we do promise to get back to you as soon as we can. At this point, I'll turn things over to Auburn's very talented assessing team. With us this evening is Karen Scammon, our city assessor, and Joseph St. Peter, our deputy assessor.
Good evening, everyone. Thank you for being here tonight. As Liz said, I'm the city assessor, Karen Scammon, and with me is Deputy Assessor Joseph St. Peter. As you are all aware now that the tax bills have gone out, the assessing department made market adjustments this year for the 2022 tax year. For some of you, you saw significant tax increases, and we are here tonight so that we can try and give you some information on how and why these adjustments were made. We hope it helps to explain and make it a little easier for you to understand. Several taxpayers have been in the office, and we have discussed with them as well. We're happy to take our phone calls, answer your questions. Please put them in the chat, and we will do our very best to get answers to you this evening. What we don't have for information at our fingertips, we will get it for you and provide it to you at a later date. It is always our mission in the assessing department to assess all properties fairly and equitably and in compliance with all mandated regulation and laws of the state. With that, I'm going to turn it over to Joe, who is going to start the presentation.
So the big question, of course, is why now? Why are we doing this now? And I think one of the simplest kind of graphics that we can put up is a single sale. On the screen, you'll see a sale of a property. It sold in 2018 for $185,500, and in 2022, this year, for $305,000. We're going to talk a little bit more about ratios in the presentation, but there's a big difference between those two ratios from 2018 to 2022. We post sales on our website, and we're going to show you a resource at the end of the presentation where you can get more information about 2021 sales on our story map. But the issue for us is that the $305,000 sale is no longer an outlier. It's our new normal, and it's typical to what we're seeing in the market. The adjustments that we made are actually based on the 2019-2020 ratios, and we'll talk more about that now. But when the sales ratio drops, that means that the sale prices are increasing, and you can see that there's quite a gap between 2018 and 2022. Next slide. So it would be remiss not to talk about the property value totals in the city of Auburn. Our total real estate is $2.5 billion. Of that, 2 billion is taxable and 450 million is exempt. And exemptions come in many forms, fully exempt properties. One of our largest categories of exemptions are the homestead exceptions, we'll also talk about. We don't just assess real estate in the city, we also assess business personal property. This will become important for a few reasons when it comes to why we have to ratio. But our personal property is at 323 million. Taxable is 101 million. And most businesses are eligible for something called the Business Equipment Tax Exemption, or BETI, which is a large number, 221 million. And what reimbursement we get back from the state is largely contingent on the ratio that we declare. In FYI, the ratio that we declare currently is 93% of market overall, and that's what we declared last year. So our total city valuation was 2.8 billion in 2021. So what changed? We added a lot of new value when we made our market adjustments. So the single family property adjustments resulted in a net increase in real estate of 178 million. We did make some other adjustments to agricultural land. That was a plus 3.3 million. And the resulting increase was a net increase, and it's just owing to normal things such as new construction, demolitions, and other reassessments and changes are also involved in that matrix. But the net remaining increase was 17 million. So it's very important when we talk about ratios. What does that mean exactly? Well, in the state of Maine, we're supposed to assess according to market value, meaning ideally, if your house is assessed at $200,000, in a supported sales price is $200,000, we have what we call a ratio of 1. That means everything is in equilibrium, and that's ideal. Of course, it's never quite that simple when you talk about the types of sales that we have and the amount of sales that we have in the city of Auburn. So a more typical ratio, if the assessed value is $200,000 and the sale price is $250,000, and we believe that's a good market sale, then the ratio is 0.8 or 80% of market. In ratios, we don't just look at one ratio or one category of ratios. We do ratios for single family properties, for multifamily properties, for commercial and industrial properties, for vacant land. So it's quite extensive, and that'll be important later on. The next slide is an example of a sales ratio study. Now, this is a very simple example showing you just a few sales. In reality, when we look at residential sales, we have hundreds of sales that have to be in this matrix, and sometimes we'll fine tune it based on certain property categories. But we determine outliers in these samples. We remove those from the samples. We determine things like median ratios, average ratios, and a lot goes into determining what our ratio is. And we're not the only ones who do sales ratio studies. The state of Maine does the sales ratio study based on data that they receive from us, and we do our own internal sales ratio studies. Okay. So kind of segueing into that, the state, it's important to note that these ratios were determined from 2019 and 2020 sales. The state determined that we had a commercial ratio of 0.98, which is very close to 1, which is good, an industrial ratio of 0.93, and our residential sales were falling in around 0.83. So if you have a low ratio, that means it's being assessed at less than market value. So in the table above, residential are being assessed less than commercial and industrial by comparison. If a class of property has a higher ratio, obviously that means they're being assessed closer to market value. And these are the actual results. These are the actual numbers that came from the state. 2022 state valuation. And again, I need to remind people that that was from 2019 and 2020. So our ultimate goal is to assess all property at their market value or just value so that there is equity between these classes of property. Next slide. So our target is to close any gaps that we have in the ratios between properties. So if we aggregate the commercial industrials, we have a 13% kind of gap between residential and commercial industrial. That's important because it maybe the best way to think of it is that we're leaving 13% off the residential assessments overall compared to the commercial industrial assessments, which is kind of a big deal. Think about it like this. If we forgot to assess your neighbor's garage or part of their house or 13% of their assessment, I think we would all agree that that's inherently unfair and that shouldn't happen. So from the perspective of the commercial industrial property owner, it's unfair. We've left something off the residential assessments and they're paying a higher tax burden as a result. So those kinds of things, one of our decisions to make these adjustments was to correct that inequity so that everybody has a fair share of the tax burden.
This slide that you're looking at right now is the certified ratio declaration form that the assessing department receives from the state of Maine each year. And as Joe just was talking about, this is determined by the Maine Revenue Services based on the ratio study, which is based on all the sales that have occurred in the city within a certain time frame. And for this particular certified ratio declaration form, as Joe said, it was the 2019-2020 sales. So they determined that our overall citywide ratio was developed at 83% based on those sales in that time period. As the assessor, we have the option to either choose option one, which is the developed ratio of 83%, and say, we are going to apply that ratio to the entire city. We're going to declare that as our ratio. Or we have other options. We have option two, which we could do a total revaluation of the city. We could implement it. And that would bring us up to that 100% market value, theoretically. And that would, then we could declare any ratio that we wanted within 10% of that 100%, as opposed to taking what they are telling us, this is your ratio, 83%. There are other selections here. The one that was chosen was a partial revaluation or the market-based adjustment. The market-based adjustment is based on sales ratio. We've had a lot of phone calls and people have asked, well, you didn't come into my home. You didn't do an inspection on the property. How do you know that my value is X? Well, we determined those values based on the sales that occurred within that time frame, and our assessed, well, we based them on the sales that occurred, which is a market-based adjustment, which is totally acceptable, and it's a good assessment practice, one of the good assessment practices. In order to go outside of that, in option two, it says, if this ratio is not between 75 and 91%, then we choose which one to. So we chose 93%, and Joe's going to go into a little bit why we chose 93%. We felt that it was the best option for the city, the best option for the taxpayers, and he'll go into it a little bit more. But because we chose that 93%, we now have to show the state that we have made these market adjustments and we have to send them a lot of information and new ratio studies based on the market adjustments in comparison to those sales from the 1920 timeframe. So that's how that 93% was chosen for the city of Auburn. We have declared 93% for the current tax year.
So talking about what went into our decision-making process of not choosing option one. So the developed partial ratio that the state of Maine told us that we had to use if we used option one was 83%. And 83% declaring that ratio has some consequences. One, exemptions, including the homestead, would be worth less. So we are at 93%. We were at 93% last year. So the homestead, the veterans, and other exemptions remain the same amount they were. If we didn't, we would have to drop those. And related to that, we get reimbursement from the state for our homestead exemptions and other exemptions. But the homestead is a big deal because we have 4,345 homestead exemptions worth over $100 million. So we get reimbursement based on that. If we dropped our ratio, that amount would be less. We lose $10.2 million in taxable personal property because now we have to adjust our assessments by the certified ratio. And related to that, we lose off that $221 million in Betty assets that we have. We lose $22 million in our reimbursement value would drop by $22 million. Any new valuations that come in would have to be adjusted by the certified ratio, and any declared assessments. We have some taxpayers that have to declare their assessments that would have to be adjusted. And an obvious consequence was that with less taxable value on the rolls, we lose, we would have to raise the mill rate. And that inequity, like we talked about between the commercial industrial properties and the residential properties, we've done nothing to correct that by simply adjusting the ratio. And it's important to us that we correct it. So the next slide is why do we go with option two? Okay, so some of the benefits that we made in order to maintain our current ratio and make some market adjustments to bring up value is that we maintain our exemptions and reimbursements at the current value. We don't have to adjust personal property, meaning we don't take a hit on the valuation base overall. We improve the equity between those property classes so that the commercial industrial properties don't feel like they're paying a higher share of the tax burden. And when they come forward with abatement requests saying we're not being treated equitably, they would have a point. So we want to make sure we're improving that equity. We don't have to make any adjustments to declared value or new adjustments because we're at the right ratio. We have more time to monitor the changing market conditions. And I think when a few years ago, when COVID first hit, we were worried that the market was going to go the other way. A lot of people are saying that we are assessing these properties at the height of the market. And the fact of the matter is we don't know what's going to happen tomorrow. Do we expect it to plateau? We do, but we expected things to go differently in the last 3 years too. So it's very hard to predict what happens next year, but by making adjustments now, we're giving ourselves a cushion for next year, and we avoid what we're calling a ratio cliff, because these ratios that we have in front of us that were the basis of the market adjustments were based on 3 years ago, and we're basically a 20% adjustment. If we look at the sales from the following year or the next year, we're looking at a ratio of around 66%, which is a much steeper ratio. By making the adjustments now, we're basing future assessments. We're comparing those sales to the adjusted values, which kind of moderates the ratios going forward, and we may be able to avoid some market adjustments, and hopefully we can delay the implementation of a full revaluation going forward. And of course, the big question that everybody has, well, what happens to my taxes? We started with a base 1.2 or 20% adjustment to all single-family properties. However, in reality, properties are very diverse and complex in the city of Auburn, so that doesn't necessarily translate to a 20% overall valuation change. We have parcels with different sizes. Some parcels have current use valuations involved. Some of them are ag land. Some of them have alternate uses. We really focused in on the single family uses of properties and made adjustments there. But I've put up on the screen some typical, these are actual properties, and it's showing their 2021 and 2022 assessments. These are without any exemptions noted in there. So some of these are moderated even further if there's a property exemption on the property as well. So the Cape is an example of a property that the assessment went from 101, 101,000 to 119, just under 120,000 assessed value. That was an increase in tax in 2,727, or excuse me, so the increase compared to the last year was $300. So the net impact is 12.93%. A condominium had a similar, had a larger increase because it was a high valuation, resulted in a net increase of 14%. A large colonial was similar. The waterfront, this looks like a very small adjustment. The reason why waterfront property may have had a smaller net adjustment was because Taylor Pond properties were adjusted in 2020, last year, based on the study that we did on the pond. There was a 10% adjustment then. Bring them up to the market with everybody else, we made another net 10% adjustment this year. And so these properties are shown without exemptions. Karen's going to talk a little bit about what property or exemptions are available to single family property.
So listed here are exemptions. If you qualify, they do have to meet the qualifications, but we do have several exemptions available. The state is actually, these are state funded exemptions: homestead, veterans, widow, blind, parsonage, paraplegic veterans. Tax benefits, I don't know what else I can tell you. These are pretty straightforward. We have all the information on all of these exemptions in the office. For these particular exemptions, all of these applications by state statute have to be in by April 1 to be effective for the upcoming tax year. So if you are out there and you're looking at these saying, geez, I think I could qualify for that homestead exemption, fill out the application, get it into the assessing department. We will hold on to it until you are qualified for it. Same with veterans. And if you have questions on any of them, these are all posted on our website as well. We have the link to each one of these so that you can read and see if you are qualified. But if you have questions, please call us. We will answer them to the best of our ability and walk you through the applications. Like Joe said, we have over 4,000 homestead exemptions. That's a very popular one, and it's a very good one. $529 savings on your tax bill is a good chunk of change. So you should really be looking into these exemptions. Also, we have current use programs. Joe and I have done several over the past year presentations on the current use, tree growth, open space, and farmland. These are a different type of program. Again, it's in state statute how they need to be assessed and who qualifies and how you qualify. However, if you have a large tract of land or in the open space And farmland, you really don't have to have too much. I mean, farmland is 5 acres. But these current use are, if you are, if you want to protect your land, if you want to protect the forest land, if you're using it to farm, if you have a classification of open space, such as opening it up to the public, or you have a scenic vista, there are tax incentives to put your land into a current use program. And of course, there are penalties if you take it out. So again, all of this information is available on the website, or we have it in the office. The property tax deferral and the property tax stabilization are new. Those are both new this year. The property tax deferral, I'm going to talk about first. It's one that the state had this program years ago and stopped it, discontinued it, and now it's been brought back. The property, both of these, property tax deferral and property tax stabilization, are geared to 65 and older, but they have many differences between the two. The property tax deferral, for instance, is income-based. And it's also one that if you enter into the program, the state will put a lien on your property for the time period that you are in the program. That's very important to know. The tax deferral, just like it says, defers your taxes for the entire time you remain in your home. It has to be your primary residence. You have to be on the deed, obviously, but the state will pay your taxes while you remain in your home. If you opt out of the program, if you no longer live in your home, if you pass away, the state needs to collect all those taxes back with interest. On the other hand, property tax stabilization is a program 65 and older, no income requirement on that one. And this is not one where the state will put a lien on your property. They are not going to pay your taxes. What happens is if you qualify for this tax stabilization, you apply to the assessor by December 1st, and it has to be every year you submit your application. This year is the initial application. If you get it in by December 1st, your taxes will be frozen at your 2022 tax bill amount. You can take those taxes with you if you move to another municipality in Maine. At this point, the way the bill is written. However, there are some, what's the word I want? There are some requirements. You have to live in your home or live in a home in Maine for 10 years as your primary residence. You have to have qualified to have a homestead exemption. That doesn't necessarily mean you had a homestead exemption. It means you qualified for a homestead exemption. That 10 years doesn't mean 10 years in one property. That 10 years means if you lived in another municipality for 4 years and then you move to another one for a couple of years. In aggregate, you must have lived in Maine as your primary residence in a home for 10 years. Now, again, that's different from the property tax deferral program. The deferral program, you apply once. You apply by between January 1 and April 1, just one application. It does require that you have a homestead exemption, not that you qualify, that you have one. So these two programs are very, very different. Property tax stabilization seems to be extremely popular with our taxpayers. We have taken in excess of 150, probably pushing 200 applications as of now. We assume that there will be many, many, many more by December 1st. It's a very simple application to file and fill out. again, both of these applications are on our website. I think Kelsey's going to show you some links on how to get to all of the exemptions, all of the tax relief programs. The current use program is in there. But always, if you have questions on any of these programs, the three of us in the assessing office are happy to answer your questions. Give us a call, come in, call and schedule an appointment if you want to sit down with us and discuss them. We're happy to do that with you. And with that,
So the question is, what's next? So we're doing their virtual town hall meeting today. Back in June, just kind of a progression here, we sent out value notices to people, letting them know that a change was happening. We're going to have, now that tax bills have gone out, people have a lot more questions. So we're trying to address those today as best we can. We're also going to have a live public meeting at the Auburn Senior Community Center on September 7th at 5:30 p.m. And we also have resources, including you can call us regarding sales, which I think is a very important data. We have sales that are posted, one on the assessing page, but we've also created something new in GIS called a story map that will show the 2021 sales. We're also going to update it with the 2022 sales shortly. But it shows, you can click on it and see what's going on in your neighborhood. Where are the sales happening? That support the market adjustments that we did and the overall sales of single family properties, that is, and condominiums and mobile homes in your neighborhood. So that's a resource that is on our website and that we can show you. Yeah, so Kelsey, so if basically it's a walkthrough, kind of what a sales ratio study is, what a qualified sale is, and it gives you data points on those sales that occurred in Auburn in 2021. So I encourage anyone who has a question about sales to go here. And one common question that we're getting is, well, my house didn't sell. How come you're making an adjustment to my property? Well, it's not just, we determine market value in the city by analyzing classes of sales or classes of properties and what they sold for. And that's how we determine what your assessed value is. So it's not just your property, it's all of them. I guess from there we take questions.
Yes, so we will address the questions in the Q&A. This is Kelsey speaking. Sorry, you can't see me. Showing you the assessing page on auburnmaine.gov. On this left-hand side is where you will see applications and forms. So if you've had a change of address, there's exemption and homestead applications here, as well as some contact information for the assessing staff. Some of those applications require that you have previous tax information, and this neighborhood link brings you to taxes. If you go to our tax page, you'll see the current tax information, including a budget agreement form. Now that budget agreement form gives you the option to do quarterly payments or monthly payments for your taxes, but it does need to be turned in by October 1st. If you click on annual tax information, this is where copies of the current tax bills and previous tax bills down below are. They are sorted by last name, which means the last name of the property owner as of April 1st of that tax year. So if you just purchased the property, you'll need to look under the last name of the person you purchased that property from.
Great. Okay, so we do have a few questions here. Craig has kind of a multiple question here, wondering about why the city didn't provide a bit more warning about the fact that taxes were going up and that taxes were raised by an incredible amount, and then the bill was due pretty quickly in 30 days. Why not put off the increase until 6 months from now, let's say? So can you talk a little bit about the timing?
Absolutely. So Craig, I talked to you on the phone. Good to hear from you. So we sent out notifications in June that adjustments were coming. The fact of the matter is until we actually commit taxes, and this year we committed taxes on July 18th, we really don't know what the taxes are going to be. There's a lot that goes into it: reimbursements for homestead exemptions, rates of what we're going. So there's a lot of moving parts when we commit. So quite honestly, we don't know what the mill rate's going to be. We don't know what your taxes are going to be until we actually put the numbers into the system and do it. The sales that we based our market adjustments on are actually 2.5 years old. So we're not even dealing with the most current market data when we made these adjustments. So we're doing the best that we can. We know this is painful. Karen and I are Auburn residents as well, so we're feeling this as well. So we understand, but this was really the best case scenario, and I know it's never going to feel right when you get an increased tax bill, but we believe we were as timely responsive as we could.
Great. Okay. So Jay has a question, again, in a couple of parts here. So if the assessments were made based on market sales, were they based on market sales that are area specific, or was it based on sale price averages from total sales throughout the city? For example, if one area of the city has higher sales, they should not be assessed the same as an area that had lower value sales.
Yes, that is correct. Our city is separated into what we refer to as neighborhoods. That's an assessing term. Neighborhoods are determined by sales. So for instance, we have upper end subdivisions that are going to have higher sales than other neighborhoods in the city that may be older. So your assessment is based on only those sales that we consider to be comparable to your neighborhood. We would not use, for instance, Fairway Drive. We're not going to compare Fairway Drive to Newbury Street. Totally different neighborhoods, totally different land values. And so we're only going to look at the sales that are comparable to specific neighborhoods to set those values.
Well, I'll add that the overall market adjustment was consistent. Sales in this review were around 20%.
Thank you. A similar question said, is our new assessment based on specific comparable sales? If so, can we find out which properties were used as comparables?
You can review our sales on the sales map, and we post those sales to our website and have for years.
And again, use that interactive map. Go to your neighborhood, go click on all of the sales within your neighborhood, and those are some of the sales that we use to determine values in your neighborhood.
Great, thank you. Another question here, if the values were raised, why did the mill rate not fall more? Do you want to talk about that?
Mill rate is a product of valuation, the budget. So in order to cover the city cost in the budget, the entire budget, the valuation has to, the mill rate has to be determined in a ratio towards the valuation and the budget. So why didn't it fall more? Because we only raise enough money to cover the budget with a little bit extra for our overlay. But that being said, it couldn't fall more or the budget wouldn't have been covered.
Okay.
something to add to that?
Well, and we only adjusted single family properties. We have other properties that weren't adjusted. So had we raised values on other classes of properties, that could have decreased the ratio more. But as we talked about, a market adjustment wasn't indicated for those other properties. Part of our problem here was to address inequity between property classes. So, single family properties were what was adjusted.
One of our guests is asking, has the certificate ratio declaration form already been submitted?
Yes.
Okay. Let's see. If the data on this assessment is based on 20-2021 sales, should we expect another raise next year? Also, can these revaluations be conducted more often so the increases are smaller moving forward in the future?
Fair point, and very possibly. And what was the first part of the question?
Should we expect another increase next year?
One of our hopes is that we've moderated that with the increase this year. Is that the ratios, because now we have now we're comparing sale prices against a new assessed value, that it's sort of blunted the effect, and we won't have to make an adjustment next year, kind of like we talked about. We're not falling off a ratio cliff because we already made ratio adjustment.
But that's not written in stone, however. I mean, if it depends on the market, what is the market going to do? Is the market going to skyrocket again? Is the market going to stay the same? Are the sales going to continue to be as high? We will wait and see what our sales ratio tells us and what that declaration from the state tells us. And it's a very good point to make smaller incremental adjustments. Then the issue with that is the market goes like this. There's always ups and downs in the market. It's always been a good practice to wait until the market levels. 3 years is a good time to watch the market. But it's easier tax-wise if we could make adjustments more often.
Okay, so I have another question here. So if we just got our bill, but normally pay our taxes through our mortgage's escrow account, is that bill the amount due in addition to the amount being collected already through mortgage?
That might be a tax collector question. I mean, obviously, the ultimate party responsible for the taxes is the property owner, and how you talk with your mortgage company, your lender. That's something you may have to communicate. Maybe they already know and they've made adjustments, but I don't know if you want to.
So the short answer is yes. The suggestion is to make sure you forwarded your tax bill to your mortgage company. It's likely that they will send you notification saying that your escrow does not have enough to cover the entire tax year. Because the tax amounts are due in 2 payments or 2 halves, generally they will cover the first half and increase your escrow amount coming from your payment for the remainder for that second half that will be due in March. It can be different with different mortgage companies. So the best suggestion is to contact your mortgage company, send them a copy of your tax bill, and find out how they do it specifically. That is generally how it's handled.
Okay, our next question is similar in nature. Will there be any changes to assessments in the future? Also, is there any recent communication coming from the state that relates residential tax burden?
If you're asking if there's any new exemptions, none that we're aware of. I know the city is talking about options, and that's not something that the assessing department has any really, that's not a decision we're making in the assessing office. And could you read the first part of that again, Liz?
Oop. Hold on.
All right.
I already moved it to the done pile.
So no, we're not hearing of any new tax relief programs. Property tax stabilization for 65 for residents 65 and over with 10 years of homestead is new. It potentially could save a lot for people when they freeze in and if there's a subsequent increase in taxes. But we don't know of anything new. Last year, they did talk about raising the homestead from $25,000 to $30,000, which actually, if that had been implemented this year, that would have blunted some of this for us, but that didn't happen.
Great. Okay, another question here. Can we see a breakdown of how our property was assessed? For example, if we have a home and other outside buildings, can we see how that was broken down to figure out our total valuation? And how soon can we get an appointment to talk to someone to go over our assessment? If the city is growing and more buildings are being built, why are our taxes rising? Are we giving TIFs to all these new buildings? So there's a lot of parts there. Is it possible for someone to get an appointment to go over their assessment with you?
Call us up and we'll make an appointment. I've been taking appointments for reassessments to look at some properties. We're doing it this week. We are busy, but we will schedule those appointments. They are very important to us, and we're going to do that.
Excellent. Thanks. Do you want to speak to growth and why that's not helping with our rising taxes at this point?
Well, it really is helping. What the growth that we've seen so far, so like I believe in my presentation, we had a net plus 17 million, which does help the overall taxes. It takes a lot to move the needle when you have when your valuation is in the billions as opposed to millions. But any new property value in the city does help, and it does help to stave off increases. So it is happening, maybe not as quickly as we would like, but we are seeing benefits from increased developments. And in fact, I would say, looking back on the past few years, some of the tax offsets have been new development. It's been helpful, and maybe we don't articulate that enough, but that property value is there, and it's making a difference.
Great, thank you. We have Scott here, who is a realtor, and he says that he disagrees with our proposed rate hike for waterfront property, and says that he knows as a real estate agent that waterfront realizes a huge profit when those properties are sold. Has a client right now who stands to make $160,000 from the sale of their property. So how does the city justify such a small increase, a 1.5% increase there?
A tax increase, 1.5?
I believe that's what he means.
Well, the net, we increased it 10% last year. We increased it another 10%. Because properties are different, the final, impact, that was one example. So that may not be, that's not representative of all the Taylor Pond value increases. If you're advocating for higher assessments, well, I'm also seeing comments of people say, well, why didn't we moderate that and phase it in? Well, we're not bringing things to full market value with our adjustments. We're only bringing them to where they were 3 years ago.
Okay, another attendee is wondering for clarification that 2-unit properties have not been impacted by this?
That is correct.
This year, that's correct. They saw an increase 2020 or 2021.
Yeah, so the past couple of years,
Yeah.
we are seeing that is a property class that needs to be adjusted because they too are rising. They rose more slowly than other classes of properties, which is why we didn't include them in this batch of adjustments. They may be adjusted next year, but again, we're keeping our eye on that. We're keeping our eye on the market. We'll see where our ratios turn up when we do the same process next year.
Right. There's another one here that says, why did my property receive an adjustment when other properties in my neighborhood didn't, since neither made improvements?
I'd have to see what property you're talking about, because if your property received an adjustment, then all properties in the neighborhood, if they were single family properties, would have also received an adjustment. But I'm happy to go over and compare. If you'd like to give me a call and tell me where your property is, and I will check the neighborhood and make sure that it was treated fairly.
And if you're using our online portal for Assess Pro, that data hasn't been updated yet. So if you're going online and you're looking at your neighbor's property value, comparing it to your tax bill, that won't be correct. So we'll update those values shortly, but we haven't done it yet.
Okay, next question is, it's pretty specific here. After the last city revaluation, there was indication that a new software was purchased and that annual assessments would automatically adjust for new sales. Was this software ever purchased? And if it wasn't, why not? If it was, why are we now seeing significant increase in valuation?
The software was purchased. It's the Patriot CAMA system. And during the last reval, taxpayers were told that there would be annual updates to the property values, and that would they would not see another citywide revaluation. It would be done incrementally each year. Why wasn't it done that way? I can't speak for prior assessors. Since I have been here, it has been our practice, like I said before, to wait until the market is stable before adjustments are made. And that's why it hasn't been increased every year. The CAMA system has the capability to do that, but it just has not been used that way.
And I'll add that, we don't just push a button and spit out value. It's about monitoring neighborhoods, looking where change is happening, boots on the ground stuff. New neighborhoods pop up over time. Old neighborhoods decline or revitalize. There's a lot that goes into assessing a community that's greater than just having a computer system that'll change the data. We have to put those data points in manually as human beings and make sure that it's being done right. So I'm not sure that any CAMA system is going to work universally and be accurate without that human element telling it what's going on and analyzing that information. So that's the reality of it. We are becoming a more computer-centric world where data is kind of aggregated and pumped out. Our ambition as an assessing department is to be fair and to be accurate, and we have to have the human element to do that, I believe.
Okay, this question is from Rex, and he asks, were the increases based on comparables, and can we see which other specific comparable sales were used? And Rex, I'm going to send you the link to that story map that's been referred to a couple of times as well.
Yeah, I mean, the sales are the sales in the city of Auburn. I mean, the comps are, we don't use comps outside of the city unless it's some special use property that doesn't exist, where we don't have other examples of it. Sales are the comps, and in a mass assessing, it's a little bit different than fee appraising, where we have, one property that we're valuing and we find 3 comparable sales, and that's it. No, we have a whole kind of galaxy of sales that we do comparisons on based on neighborhood, the use of the property, and information like that. So the comps are there. I mean, you can go to the story map, check out those sales that happened in your neighborhood. You can look at the sales listings that we've been putting on our website from the assessing page. Those are the comps.
Another good question here. Considering Maine's cost of living is one of the highest in the nation, is there any plan or program for mitigation of tax burden, whether state, county, or city? The rate of these increases does not seem sustainable.
So I'll say that there is consideration going to the council. There's a workshop at the next council meeting to discuss a homeowner relief program. You're welcome to attend that meeting. It is a council workshop. That's part of what's being discussed is a homeowner relief program.
Sometimes I'm also surprised when we see properties, when we see single family property owners or even multifamily property owners who have a primary residence and they don't have the homestead exemption. So if you're a taxpayer, ask yourself, do you have these, or do you qualify for these exemptions, and should you apply for them? So it's a very popular program that the legislature seems to update it every so often. It used to be not too long ago, it was $10,000, and it went to $20,000, $25,000. Who knows what adjustments are made in the future? I would also suggest for people who are, asking about relief programs, talk to your legislators. I mean, the state of Maine, I think there's a possibility when citizens are heard.
Great point. There's a question here about commercial properties. Why commercial properties rates were not adjusted. This would have lowered the overall mill rate. This person thinks that the 22% mill rate for Auburn is just too high and compares the rate in Portland, which is at 13%.
So commercial properties were not adjusted this time around because our sales ratio studies showed that commercial properties were already being adjusted, already being assessed at 98% of market value, and industrials were at 96% of market value. So early on in the presentation, Joe discussed the gap in the ratios between the single family and the commercial industrial. So they're being assessed pretty darn close to 100% of market value. And we ultimately closed that gap by making these adjustments to the single family. Portland's mill rate is low because they just completed a full revaluation of their city, which brought in a tremendous amount of value, bringing everyone up to 100%. If we did a revaluation, a full citywide, theoretically bringing it up to 100%, normally we too would see a very large drop in our mill rate. So is that on the horizon? Absolutely, because you can't continue to make only market adjustments to certain classes of properties. It's something that's an acceptable practice to do until such time that you can do a citywide complete reval, commercial, industrial, and all classes of residential properties.
Okay, the last question here is a bit tricky, but I think that hopefully with everything the team has presented and the questions we've answered tonight will help you understand this. The question from Craig is that how can we not realize that citizens are struggling to buy gas, food, and that this tax increase is an additional expense they can't pay? Again, I'll reiterate what Kelsey said, that to tune into the next city council meeting during the workshop. The council and mayor are going to explore some options for some homeowner relief. That's not carved in stone, but I'll defer to you, Karen and Joe.
Well, we do realize, I know how much it costs to fill my oil tank. I know how much gas costs. We are very sympathetic. I know that doesn't massage anyone's feelings on the matter. In our opinion, it was the right thing to do. And sometimes the hard thing is it's not going to be popular, but we believe that we're creating equity with the adjustments that we made, that we're following the rules established by the state of Maine, and we're doing everything we can. And we will, if you call us and you want us to check your property, we're going to do that. Property owners tend to know things about their properties. I believe we don't have the assessment right. We want to hear from you. This is tough. We know it's tough, and we're sorry.
We have a question just popped up. What is the cost for a full city revaluation? Is that something you can estimate, Karen?
The cost is dependent on the scope of the revaluation. There are many, many different ways to do a revaluation. You can do, all in-person inspections. You can use imagery. You can do it so many different ways that really, I don't want to throw any numbers out there. I can tell you that it is extremely costly, and it is something that we would have to most likely start with a CIP budget and put money in it over years of time to have enough to do it properly.
Great, thanks. Let's see, looks like one last question that is, there's so much difficulty with cost of living, with housing and food insecurity, but class inequity was mentioned here, equating commercial and industrial real estate with people. Not sure.
No.
Is the priority of valuations the quality of life in Auburn, or Auburn as an item in an investment portfolio is the question.
Our interest is making sure we're assessing properties according to their market value. There's no judgment on class. When we're talking about class of properties, we're referring to commercial or residential or multifamily. That has nothing to do with any social factor. It's about type of property.
Excellent. Thanks so much. So we are coming up on 7 o'clock, which is our end time that we've had scheduled here. And I don't see any remaining questions. So we're going to bring this virtual meeting to a close at this time. For all of our guests, I remind you that there will be another opportunity to learn more and to ask our team questions. We're holding an in-person version of this meeting on September 7th at 6:00 p.m. at the Auburn Senior Community Center, which is right next to Auburn Recreation in Pettingill Park. We hope you'll consider joining us there. So on behalf of City Manager Phil Kroll, the Mayor and City Council, and our dedicated team here at Auburn City Hall, we thank you for joining the City of Auburn for this virtual town hall meeting, and we hope to connect with you again